On September 25, 2008, a 119-year-old dynasty vanished in a single afternoon. It wasn't just a bank, it was an American icon. Washington Mutual, known affectionately by millions as WaMu, had $307 billion in assets, over 2,200 branches, and more than 43,000 employees. For over a century, WaMu was the bank of the people. It survived the Great Fire of Seattle, the Great Depression, and 2 world wars. It was a conservative, community-focused pillar of stability. Yet, in just 9 days, a massive bank run saw $16.7 billion evaporate from its vaults. This wasn't just a bankruptcy, it was a seizure, a government-forced execution. While the world watched Lehman Brothers burn, the death of Washington Mutual was the moment the 2008 financial crisis hit the average American's doorstep. How did the nation's largest savings and loan, a company that prided itself on being the friend of the homeowner, become the biggest casualty in banking history? Was it simply a victim of the housing bubble, or was there something more sinister lurking behind the friendly WaMu Way slogan? Today, we tell the complete story of the rise, the peak, and the spectacular fall of Washington Mutual. To understand the end of WaMu, we have to travel back to its beginning. The year is 1889. The place is Seattle, Washington. At the time, Seattle was a booming frontier town, but on June 6, 1889, a tragedy struck that would change its fate forever. A glue pot in a carpentry shop caught fire, sparking the Great Seattle Fire. By the time the sun went down, 25 city blocks, the heart of the business district, were reduced to smoldering ash. 120 acres of the city were gone. The city needed to rebuild, but there was a problem: money. Commercial banks at the time were elitist. They lent to corporations and wealthy land developers, but they wouldn't touch the common man, the blacksmiths, the shopkeepers, and the families who needed home loans to rebuild their lives. On September 21, 1889, just months after the fire, Seattle Mayor Robert Moran called a meeting of the city's most prominent businessmen. They didn't want to start just another bank. They wanted a building and loan association. Their goal was simple: to pool the savings of ordinary people to fund the home mortgages of their neighbors. Originally incorporated as Washington National Building Loan and Investment Association, the company was born from the literal ashes of a catastrophe. The primary founder, Edward Oziel Graves, was a man of impeccable credentials. He had served as the Assistant Treasurer of the United States and the head of the Bureau of Engraving and Printing. Graves brought a level of trust and legitimacy to the institution that was rare in the Wild West. Alongside him was Ira Hill Case, the company's first and, for a while, only employee. Case was a tireless salesman who fanned out across Washington and Oregon, selling shares in the association for just a few dollars a month. This was the era of the mutual model. In a mutual bank, there were no outside shareholders. The depositors are the owners. Every person with a savings account had a stake in the bank's success. This created a conservative, risk-averse culture. If the bank lost money, the depositors lost money. In 1908, the name was changed to Washington Savings and Loan Association. By 1917, they converted into a mutual savings bank. For the next 70 years, Washington Mutual Bank would operate on a philosophy of slow, steady, and safe growth. They weren't trying to conquer Wall Street, they were trying to help the Pacific Northwest own its homes. They pioneered the penny deposit program for school children, teaching an entire generation the value of thrift. They were the first to offer amortized mortgages, loans you paid off slowly over time on the West Coast. By 1930, while other banks were collapsing during the Great Depression, WaMu was actually so trusted that it grew, acquiring its first competitor, Continental Mutual. For nearly a century, Washington Mutual was a quiet, regional bank. But in 1983, everything changed. The banking industry was being deregulated, and the leadership at WaMu saw a choice: stay small and be eaten by a bigger fish, or grow and become the predator. They chose growth. Under CEO Lou Pepper, Washington Mutual did the unthinkable. They demutualized. They transitioned from a depositor-owned association to a publicly traded corporation on the New York Stock Exchange. This was the big bang for WaMu. With a massive influx of capital from public investors, the bank began an acquisition spree that would stun the financial world. Throughout the 80s and 90s, they weren't just buying banks, they were buying a future. They acquired Murphy Fair, a brokerage firm, marking their entry into diversified financial services. They snapped up competitors in Oregon, Idaho, and Utah. By 1989, their 100th anniversary, WaMu's assets had doubled in just 6 years. But the true architect of the modern WaMu empire was yet to take full control, a man named Cary Killinger. Every empire has its architect. For Washington Mutual, that man was Cary Killinger. Killinger didn't come from the world of stuffy Ivy League banking. He was an Iowa boy who played the trumpet and fixed up run-down houses in his spare time to make ends meet. He joined WaMu in 1983 when the bank acquired his investment firm, Murphy Favre. By 1990, Killinger was named CEO. He was 40 years old, driven, and possessed a vision that was radical for its time. He didn't want WaMu to be a bank, he wanted it to be a retailer that just happened to sell financial products. Killinger's strategy was simple: volume. He realized that the mass market, the everyday people who were often ignored by the giants like J.P. Morgan and Goldman Sachs, was a gold mine. He famously predicted that by 2008, WaMu would be the Walmart of banking. He wanted to do to the financial industry what Starbucks had done to coffee: make it ubiquitous, friendly, and indispensable. Killinger knew that most people hated going to the bank. It was intimidating, it was cold. So he introduced what insiders called the WaMu way. They launched the Ocasio retail concept. Gone were the velvet ropes and the thick glass barriers. Instead, you were greeted by a concierge. The branches looked more like a Gap store or a coffee house than a financial institution. Tellers were now associates who wore casual clothes and stood at open circular kiosks. The marketing was brilliant. They leaned into their mutual roots, even though they were now a public company. Their slogan was the power of yes. They were the first to make free checking a household term. They marketed themselves as the anti-bank, the bank for the rest of us. And it worked. Customers flocked to WaMu. Between 2000 and 2005, WaMu's brand recognition skyrocketed. They weren't just winning customers, they were winning hearts. But behind the friendly smiles and the hoo-hoo commercials, the engine that was driving this growth was becoming increasingly reliant on a single, volatile fuel source: the American mortgage. To become a national player, Killinger knew he couldn't just build branches, he had to buy them. In the late 90s and early 2000s, WaMu embarked on one of the most aggressive acquisition streaks in corporate history. In 1997, they bought Great Western Bank for $6.6 billion, overnight becoming a massive player in California. Just a year later, they swallowed H.F. Amundsen & Co., or Home Savings of America, for nearly $10 billion. These weren't just additions, these were seismic shifts. They didn't stop at the West Coast. They bought Bank United in Texas. They bought the Dime Savings Bank of New York. In a single decade, Killinger transformed WaMu from a regional thrift with 30 branches and $7 billion in assets into the 6th largest bank in the United States, with over 2,200 branches and $300 billion in assets. By 2005, WaMu was the 3rd largest mortgage lender in the country and the 9th largest credit card company after buying Providian. On paper, it was a masterpiece of expansion. Killinger was hailed as a genius, the stock was soaring. But there were growing pains. Integrating dozens of different banks meant that WaMu's back-end systems were a mess. Escrow accounts were bungled, property taxes were missed, and mortgage payments were lost in the shuffle. More importantly, to pay for these massive acquisitions and keep the stock price high, WaMu needed to generate massive, immediate profits. In 2004, the traditional mortgage market began to cool. The safe borrowers, those with 20% down and perfect credit, already had their loans. To maintain the double-digit growth that Wall Street demanded, WaMu needed to find new ways to say yes. They pivoted. They began to aggressively push option ARMs, adjustable rate mortgages. These were the ultimate power of yes products. They allowed a borrower to pay a very small amount, sometimes not even covering the interest, for the first few years. It was a pay-what-you-want mortgage. For a family in a hot market like Las Vegas or Miami, it seemed like a miracle. But inside the bank, the WaMu way was morphing into something else. The focus shifted from serving the community to feeding the machine. Loan officers were pressured to push the most profitable loans, which were often the riskiest for the borrower. The conservative values of 1889 were being replaced by the boom-time greed of the 2000s. WaMu was standing at the very top of the mountain, but the ground beneath them was starting to crack.
By 2006, Washington Mutual was on top of the world. It was the nation's largest savings and loan association and the sixth largest bank in America. They had 43,000 employees and over 2,300 branches. Kerry Killinger's Walmart of banking dream was no longer a vision, it was a reality. To the public, WaMu was the good bank. They were the bank that gave a mortgage to the family the big Wall Street firms ignored. They were the bank that offered free checking for life. They were even named one of the best companies to work for by Fortune magazine. But behind the scenes, the source of this massive growth was a strategy of extreme risk. In a 2004 memo to his board, Killinger stated that subprime and adjustable rate mortgages, ARMs, would be the primary driver of the company's growth. They weren't just participating in the housing bubble, they were inflating it. At the center of WaMu's strategy was their flagship product, the option adjustable rate mortgage. On the surface, it sounded like the ultimate consumer-friendly tool. It gave borrowers 4 choices every month: a full principal and interest payment, an interest-only payment, or a minimum payment. The minimum payment was the trap. This payment was so low it didn't even cover the monthly interest. The unpaid interest didn't just disappear, it was added to the total balance of the loan. This is called negative amortization. Imagine buying a $300,000 house, making your payments every month, and waking up a year later owing $310,000. WaMu loved these loans because they could book that unpaid interest as profit immediately, even though no cash had actually entered the bank. Between 2004 and 2007, WaMu underwrote a staggering $184 billion in these option ARMs. But who was selling these loans? To fuel the conveyor belt, WaMu had acquired Long Beach Mortgage, a subprime lender notorious for its lax standards. Long Beach was known for stated income loans, also known as liar loans. You didn't need a tax return, you didn't need a pay stub, you just had to state what you made. The decline didn't start with a stock crash, it started with a whisper from the bank's own risk managers. As early as 2005, internal audits began to find terrifying levels of fraud and incompetence. In one audit, of 4,000 loans, only 950 were found to be properly qualified. Loans were being approved for people with no jobs. Property appraisals were being inflated by thousands of dollars. One whistleblower later testified that loan officers were literally using whiteout on documents to change income levels. Killinger and his top executives were warned. The bank's own risk management team told them that the concentration of option ARMs in hot markets like California and Florida was a recipe for disaster. But the warnings were ignored. The executives were incentivized by short-term stock performance and massive bonuses. If they stopped lending, the growth story would die and their personal fortunes would vanish. In 2007, the miracle ended. Interest rates rose and the housing market, the only thing keeping the option ARM dream alive, began to cool. Suddenly, those minimum payments were no longer enough. The loans were recasting, meaning the payments were jumping by 200 or 300%. Borrowers who were already living paycheck to paycheck couldn't pay. The power of yes was turning into a mountain of no. For the first time in modern history, Washington Mutual was bleeding. In the third quarter of 2007, the bank reported that its single-family residential mortgage portfolio was deteriorating rapidly. They had to set aside billions for loan losses. To save cash, WaMu did something it hadn't done since the Great Depression. It slashed its dividend by 73%. The stock, which had traded at $45 a share in 2006, began a slow, painful slide toward $20, then $15. Killinger tried to reassure the public. He said the bank was well capitalized. He said the housing downturn was manageable, but the market knew better. The Walmart of banking had built its empire on a foundation of toxic debt, and the rain was starting to fall.
By the spring of 2008, the Walmart of banking was in a state of emergency. The housing market wasn't just cooling, it was frozen. To stay alive, Kerry Killinger needed a miracle. He found it in David Bondman and his private equity firm, TPG Capital. In April, TPG led a group of investors to inject $7 billion into Washington Mutual. It was meant to be a vote of confidence, but there was a catch, a poison pill. The deal was done at $8.75 a share, a massive discount from where the stock had been just months prior. Existing shareholders were furious. They felt betrayed. To make matters worse, to secure the $7 billion, WaMu had to slash its legendary dividend once again, this time to a mere 1 cent. The bank that had built its reputation on the mutual spirit was now a ward of private equity. The $7 billion was supposed to buy time. Instead, it bought a front-row seat to the collapse. By June 2008, the losses from the option ARM portfolio were coming in faster than TPG's cash could cover them. The board of directors finally snapped. Kerry Killinger, the man who had led the bank for 18 years, was stripped of his chairmanship. By September 8, 2008, he was fired. His replacement was Alan Fishman, a veteran banker who was handed a $19 million signing bonus to steer a ship that was already underwater. Fishman arrived in Seattle on a Monday. He would only be CEO for 17 days. September 15, 2008, the day Lehman Brothers filed for bankruptcy. The global financial system suffered a massive heart attack. In Seattle, the panic turned local. Depositors at WaMu didn't care about free checking anymore. They cared about their life savings. A silent, digital bank run began. This wasn't like the 1930s with crowds shouting in the street. This was a quiet drain of liquidity through wire transfers and online banking. Between September 15th and September 24th, customers withdrew a staggering $16.7 billion. That is nearly 10% of the bank's total deposits, gone in just 9 days. On some days, the bank was losing $2 billion every 24 hours. The power of yes had become a power of run. September 25th was meant to be a day of celebration. It was the 119th anniversary of the bank's founding. Instead, it became the day of its execution. The Office of Thrift Supervision, the OTS, determined that WaMu was in an unsafe and unsound condition. They couldn't wait another day. If the bank opened on Friday, there might not be enough cash left to hand out to a single customer. At 9 p.m. Eastern Time, the government seized Washington Mutual. They didn't even give Alan Fishman a chance to finish his dinner. The FDIC was appointed as the receiver. In a prearranged deal, they immediately sold the banking operations to J.P. Morgan Chase for $1.9 billion. The largest bank failure in U.S. history happened in a flash. J.P. Morgan Chase didn't just buy a bank, they bought a national footprint. They got 2,200 branches and millions of customers for a fraction of their value. For the shareholders and bondholders of WaMu, the value went to zero. The $7 billion TPG investment was wiped out in an afternoon. Did Washington Mutual fail? Yes, but why? It failed because it abandoned its mutual soul for the public greed of Wall Street. It failed because it bet $184 billion on the idea that housing prices would never fall. It failed because its leaders ignored their own risk managers in favor of record bonuses.
But perhaps most importantly, it failed because of confidence. In banking, you don't actually have everyone's money in the vault. You have their trust. Once that trust evaporated during the 9-day run, the oldest bank in the West was nothing more than a ghost. When the dust settled on September 26, 2008, the Walmart of banking was gone. But while the banking operations continued under the Chase Blue logo, the human and financial wreckage was immense. For the 43,000 employees, the transition was a period of deep mourning. While J.P. Morgan Chase kept many of the branches open, thousands of back-office jobs in Seattle were eliminated. A city that had seen WaMu as its local champion felt a hole in its heart. The investors, from pension funds to everyday people who had put their trust in the power of yes, were wiped out. The stock, once nearly $50 a share, was worthless. The bondholders, who'd lent the bank billions, lost nearly everything. David Bonderman and TPG Capital, the private equity giants who tried to save the bank just months earlier, suffered one of the largest single losses in private equity history. $7 billion vanished in less than 6 months. In the years that followed, there was a public outcry for accountability. A Senate subcommittee delivered a scathing report on the bank's failure, accusing Kerry Killinger and his executives of creating a mortgage mill that prioritized quantity over quality. The FDIC sued Killinger and 2 other top executives for $900 million, alleging gross negligence. They pointed to the fact that Killinger received $25 million in compensation in the very year the bank failed. However, in the end, the system proved too complex for easy justice. In 2011, the Department of Justice closed its criminal investigation into Washington Mutual without filing any charges. Killinger eventually settled the civil lawsuit for a fraction of the original demand, and he remains one of the few CEOs of that era to maintain his innocence, later writing a book titled "Nothing is Too Big to Fail." What is the legacy of Washington Mutual? It is a permanent chapter in the textbook of what not to do in banking. First, it taught us that trust is liquid. A bank can have hundreds of billions in assets, but if it loses the trust of its depositors, it can die in 9 days. Second, it exposed the danger of incentives. When you reward loan officers for the volume of loans rather than the quality of loans, you are building a house of cards. The President's Club trips to Hawaii were funded by mortgages that were destined to fail. Finally, it redefined too big to fail. While the government chose to rescue Citigroup and Bank of America with taxpayer billions, they allowed Washington Mutual to be seized and sold. It serves as a reminder that no matter how big you are, if your business model is built on negative amortization and liar loans, the government may not be there to catch you. Washington Mutual started with a noble purpose: to help a burned-down city rise from the ashes. For 110 years, it fulfilled that mission, helping millions of families achieve the American dream of homeownership. Its tragedy was not its beginning, but its end. When it forgot the mutual in its name, it traded the slow, steady safety of the community for the fast, reckless growth of the global market. Today, the WaMu name is a ghost, a relic of a time when we believed the power of yes was limitless. But as the empty towers in Seattle and the thousands of foreclosed homes across America testify, sometimes the most important word in banking is no.